Hello everybody, welcome back. I hope you had a good day today. We actually, I'm just going to recall whatever we discussed in the yesterday's class. The first thing that we talked about in the yesterday's class was actually a recall of what we had discussed in the first day. That was about the overall audit planning. That what exactly is the audit planning all about? Okay. We did discuss about the various. We talked about the audit risk. We went through one of the question about the audit risk. Once we did the audit risk scenario, then I actually moved forward and I started discussing about the audit procedures pertaining to EPS and pertaining to the short-term investment. So we went through that also. And then at the next stage, what we actually did was we moved forward and we said that the next stage of the audit is actually the review stage. And what exactly is that review stage of the audit? So in that, what we talked about was, we said that once you have performed the audit, then the next step is about the finalization of the audit. So whenever we talk about finalization of the audit, so what actually happens is that the senior manager or a partner, he actually reviews the work that has been performed up till now. He reviews the working papers, and the result of that whole review is that he is then able to actually judge if the entity, if the audit firm can actually move forward and can go for the conclusion of this audit or not. So that's what we discussed yesterday. We are going to continue with the same thing today also. So first thing that we are going to do is that you have the handouts here. You have the handouts available in this handout section. The first question that we are gonna start discussing today is going to be question number 2 of it's going to be question number 2 of December 2014. So it's going to be December 2014 question number 2. December 2014 question number 2. So the question December 2014 question number 2, let's come on to that question and we'll discuss that. The requirement to the question is then again the same requirement, which is comment on the matters to be considered and state the audit evidence that you would expect to find in your review of the audit working paper. So it's then again comment on the matters to be considered and explain the audit evidence that you would expect to find in your review during the review of the audit working paper in respect of each of the issues described above. So let's take 3-4 minutes and go through part A of the question. So then we will start discussing once you are done with part A of the question. Read part A, take 5 minutes. The name of the question is Williams and Co. In fact, it's Francis Group. The name of the question is Francis Group. Okay, let's just start discussing this question. If I talk about this question, so see that it says you are the audit manager, you're a manager in the audit department of Williams and Co. and you're reviewing the audit working papers in relation to Francis Group, the group, whose financial year ended on 31st July 2014. So the year end is financial 31st July 2014. Your firm audits all components of the group. I am going to explain this, what do we mean by all components of the group. So we're going to talk about it, which consists of a parent company and 3 subsidiaries, Marks, Roberts and Teapot. The group manufactures engines which are then supplied to the car industry. The draft consolidated statement of financial position recognized profit and loss of 23, total assets of 450, and last year it was 455 million. Now, let's just try to understand a few things, which is number one, we haven't actually gone through the group audit yet, but there is an AISA which is called AISA 600. Which is the special considerations and the audit of group financial statement. When we talk about AISA 600, that what is AISA 600 all about? So AISA 600 actually is applicable for the group audit. And what does AISA 600 states? So AISA 600 actually refers to a concept of component. And what is a component in accordance with AISA 600? So component in accordance with AISA 600 is an entity whose results are included in group financial statements. Whose results are included in group financial statements. That means whenever we talk about a component, so the component could actually be your subsidiary. The component could actually be an associate. The component could actually be a joint venture. The component could be anything. So it could be subsidiary, it could be associates, it could be joint venture. Generally speaking, what happens is, usually what happens is there is the parent company's auditor who usually audits the components, but that's not necessary. So at times what happens is when the component has a different auditor, then what happens is, since you will be forming an opinion on the group financial statements, group financial statements include the information pertaining to the component also. The group financial statements include the information containing to the component also. So if you are auditing the group financial statement, then what actually happens with the group financial statement is that you have to rely on the work of the component auditor. You have to rely on work of component auditor. So when we have to rely on work of component auditor, so we need to be a bit careful before we place reliance, because the reason behind that is, if let's say that results of component are misstated. Let's assume if the results of component are misstated, results of component are misstated, then what will happen is it will lead to group financial statements to be misstated also. And if you are auditor for the group, you will be responsible for the opinion that's being formed on the group financial. You will be responsible for the opinion formed on the group financial statement. So as a group auditor, you need to understand that whether you should place reliance on the work of component auditor or not, you need to understand that specific factor. So that is one thing. Now let's move forward and let's just discuss further. So that is what we have talked about when it comes to the group financial statement. That is what we have talked about. Now let's move forward. So in this case, if you're going to see, it says you're a manager in the audit department of Williams and Company, reviewing, etc., etc. You could actually see this thing, that you audit all the components of the group, which means that reliance on the work of the component auditor actually goes down, mean that the overall risk for the audit actually goes down. But one thing is, last year it was 23 million as the profit, current year it's 33 million. That means there is a 10 rupee decline in the profit over a 33 million, which is equivalent to something like 31-32%, something like that, a decline in the profit, which is a surprising element. And the thing is, there are total assets which are 450 and 455. So if you talk about the total assets, so you would say that total assets have only declined by 450 divided by 455. So that's how it is. Let's move forward. If we move further, we will discuss that information in respect of the three issues has been highlighted for your attention during the file review. It says an 80% shareholding in Teapot was acquired on 1st August 2013. Remember, the dates are very important. When did you acquire on 1st August 2013, which was the first day of the current year? It says the goodwill on the acquisition was 27 million and was calculated at that date and remains recognized as intangible at that value at the year end. Now, let's just try to understand one thing. It remains at that value at the year end also. Now, what does this mean? IS 36 states that the goodwill should be tested. The goodwill should be tested for impairment at each year end. Impairment at each reporting date. So the goodwill should be tested for impairment at each reporting date. That's what IS 36 states. Now, if you see this scenario, you could see that the company's profits are going down. So whenever the company's profits are going down, so if the profits of the company are going down, this would actually lead to an indication that the company is not generating cash flows. And if the company is not generating cash flows, that's an indication of impairment of goodwill. But the question says that the goodwill was originally calculated at 27 million and it is still being carried at 27 million. That means they have not tested the goodwill for impairment. They have not tested goodwill for impairment. That's what it indicates. So that's the first thing that has that's what we have actually gone through in the question and we have understood. Now let's move forward and discuss further. It says the goodwill calculation performed by the group's management is shown below. Number one is purchase consideration 75, fair value of the 20% NCI 13,000, and less the fair value of identifiable net assets is 61 and the goodwill is 27,000. If you move further, it says in determining the fair value of identifiable net assets at acquisition, an upward fair value adjustment of 300,000 was made to book value of property, recognized in Teapot's financial at a carrying amount of 600,000, and then it says a loan of 60 million was taken out on 1st August to help finance the acquisition. Loan carries an annual interest rate of 6% with interest payments made annually in arrears. The loan will be repaid in 20 years at a premium of 5 million. Now, let's just try to actually understand. We did discuss that whenever the question requirement is comment on matters to be considered and state the audit evidence that you would expect to find. So what are you going to talk about? You will talk about the materiality. The first thing that you will talk about the materiality. If I say what is materiality, let's just understand. Number one of them is 27 million. So the 27 million is actually the goodwill. And if I compare, this goodwill has to be compared by 450 million, which is being the total assets. So it's 27 divided by 450, which I guess is around something like 6% or 5 point something percent. So which is actually a material element. This is material, number one. Number two is, so this is material. Now next thing is the purchase consideration of 75, fair value of NCI was so and so, so and so, and in determining the fair value it had this upward adjustment. Now in addition to this, there was this 60 million of the loan. The 60 million again divided by 450. So it then again gives you something like you would have this, you would have more than this, some 15-16%, if you could actually calculate the correct percentage. So but I think that this is material. %13%. So okay, so that is 13.3%. So that is material. Now what next? So what will we do? We'll talk about the accounting treatment, we'll talk about the materiality, and we'll talk about if there are any risks pertaining to it and any things that are there, and then we can actually talk about the evidence. So let's just talk about the first thing, which is we would talk about the goodwill calculation, and we would say that goodwill is material as it is 6% of total assets, or whatever that is the correct percentage. Okay. I'm sorry, everybody. There was some problem with the connection, so we lost the connection. But we are back now. Sorry about that. Anyways, coming back to what we were discussing. So what we actually need to do is that we need to talk about materiality. We talked about materiality. The next thing is that we need to talk about the accounting treatment. So what exactly are we going to do? We would say that goodwill should be tested for impairment at year end, and any impairment loss shall be recognized in P&L. Furthermore, if the property is depreciable, then excess depreciation on fair value adjustment shall also be recognized. So you'd see this, that basically we are talking about the accounting treatment. We are talking about it that the goodwill was calculated. We calculated the materiality of the goodwill, and once we calculated the materiality of the goodwill, we also talked about the relevant accounting treatment for the goodwill. And what is going to be that relevant accounting treatment for the goodwill? So the relevant accounting treatment for the goodwill is going to be that you need to test this goodwill for impairment at the year end. And if there is any impairment loss, you need to recognize this impairment loss into the profit and loss account. Furthermore, what we need to do is we need to actually, we have made a fair value adjustment and upward value adjustment to the property recognized in Teapot's financial statement. So what do we need to do? What we actually need to do is that we need to actually charge an excess depreciation on this upward valuation that has been done. So the upward valuation that has been done, we need to charge an extra depreciation onto it. That's what we need to do. So you are going to write that accounting treatment, and if there are any risks which you think are there, then you can write those risks also. Like over here, the risk would be that the fair value, the risk might actually be that the fair value of non-controlling interest is incorrect. That is one of the risks. Another risk could actually be the fair value of identifiable net assets. The fair value of identifiable net assets not correctly recognized. That could be also things, but that could all have an impact on the goodwill calculation. So that is one thing that you will talk about. So you identified goodwill, you talked about its accounting treatment, and you will talk about that what could actually be the problems with respect to this goodwill. A depreciable property or if it's a non-depreciable item. So you need to recognize the extra depreciation. Extra depreciation is like for the individual books, it was 600,000 as the carrying amount. For the group accounts, it's actually 900,000. So there is going to be an extra depreciation involved. Okay, then what has happened is you have obtained a loan of 60 million on 1st August 2013 to help finance the acquisition. The loan carries an annual interest rate of 6% with interest payments made annually in arrears. The loan will be repaid in 20 years at a premium of 5 million. See, if this loan is repayable at premium, if this loan is repayable at premium, then what does this indicate? If the loan is repayable at premium, this actually indicates that you need to calculate the effective interest rate. You need to calculate the effective interest rate. Now, if I give a general or a basic example of what exactly is an effective interest rate, so I'm going to say effective interest rate is like this. If you talk about this loan, it's this loan is actually 6%, 60 million. This loan is 6%, 60 million loan for a 5-year term. So if I talk about it, you would see that the payment on this loan that you will make over a period of time, you need to see. You'll say year 1 till year 5, it is going to be 6% into 60 million into 5 years. So if I say 6 6 is 36, it's 3.6 million and 5 3 is 15, 5 6 13. So it's going to be 18 million, which is going to be the interest to be paid over a period of 5 years. And then when we are gonna repay, so basically the repayment is going to be in total. In fact, if we see, we have received 60 million, we are going to pay this 18 million and we are going to repay 65 million. So effectively, if you see, it's 60 minus 18 minus 65, it gives you 23 million as the payment over a period of 5 years. If you divide it by 5, you would come across something like 4.6. So if I say 4.6 divided by 60 give you some other rate. What is that rate? $4.6 divided by 60. Okay, so this is 7.6%. Now what is this 7.6%? This 7.6% is indicating the overall cost, on this specific loan. It is indicating the overall cost on this specific loan. So the IFRS 9, it requires us to recognize the finance cost using effective interest method. The IFRS 9 requires the finance cost using the effective interest method. So what do you mean by that? That actually means that what you do is that if it's 7.6, I mean it's just random, otherwise practically we use the IRR for calculation, but I've just performed a calculation just to give you people an idea that this is the overall cost that you're bearing over a period of time. So what happens is, like you've got an opening liability of 60 million, you will have effective interest at the rate of 7.6%, which gives you 4.6. You have got cash interest at the rate of 6%, gives you 3.6. So there is actually an amortization of 1 million which will be added to it and it will become 61 million. So the way it has to be accounted for is basically it's going to be the way it is going to be accounted for is going to be that we would recognize finance cost as 4.6 million. We would recognize the cash as 3.6 million. And we would recognize the financial liability at 1 million. So that's what we will do. That's how we would recognize this whole. That's what we will do. That's how we will recognize this whole. Now, let's just try to understand things. What has actually happened is, this is what the accounting treatment is, that if you have got a financial liability, so you have to carry that liability and amortized cost. And we talk about the carrying the liability and amortized cost. That means the interest to be recognized in the profit and loss should be using effective interest rather than the cash interest rate. So that's what you have to explain. So you have to explain that the overall what you need to explain with respect to this entire thing is, you need to tell this examiner that look, this liability is basically of 60 million is a material item, but it has to be recognized. This liability of is material item, but the accounting treatment has to be like this, that it has to be carried at amortized cost with the finance cost recognized in the profit and loss account to be using the effective interest rate instead of the cash interest rate. So that's how you will actually answer it. I'm going to move forward and I'm going to now discuss further. So if I move further, I am going to discuss about the evidences. So this is what you would talk about, the accounting treatment. Now the evidences. I've always told you that you need to think that what is the risk. Once you have thought about the risk, then you actually try to perform the procedures to address those risks, and the result of the procedure is you get an audit evidence. The result of the procedure is you get an audit evidence. Now, let's just try to understand this thing. If I say risk, the procedure and the evidence, so what am I going to do now? What are the risks that you face in this scenario? The risk that we are facing in these scenarios is, number one, the fair value of NCI to be incorrect, the cost of investment to be incorrect. Another risk that we are facing is that the cost of investment will be incorrect. The other risk that we are facing is goodwill is not tested for impairment. That's another risk that we are facing. If I move further, so it would be like the goodwill is not tested for impairment, and then the property, no excess depreciation charged. Then if I move further, I would talk about that loan is carried at the loan is basically carried at its original carrying amount. Then there would be that instead of cash interest, instead of effective interest, you have recognized the interest expense at cash interest. So there could also be the thing that cash interest is recognized instead of effective interest. So now, if we actually come across these things, so what can we do in this scenario? We could actually have a lot of evidences, because you see the evidences, then again, for those who were not here in the yesterday's and day before yesterday's class. So I did talk about it that whenever the examiner says evidence, so you need to distinguish between the evidence and the procedure. The procedure is an action that you perform as an auditor. Evidence is the result of the action that you obtain. Evidence is the result of the action. So there is one thing which is called procedure. There is one thing which is called the evidence. The procedure is the action, and evidence is the result of the action. So if I am facing a risk that the fair value of the non-controlling interest is not correct, what am I going to do? I'm going to simply perform the procedure, which is I'm going to recalculate fair value of NCI, or I might actually recalculate the fair value of the NCI using stock exchange data. Using stock exchange data. So my evidence would actually be, my evidence for the purchase for this NCI would actually be that I would expect to find recalculation. I would expect to find recalculation of NCI. I would expect to find the recalculation of NCI. I would expect to find the stock market information extracts showing the value of teapot company. Then you have got cost of investment, which could actually be using the share purchase agreement. So the share purchase agreement could tell you the goodwill, could be the impairment workings. The impairment working could tell you whether the goodwill has been tested for not, or etc. etc. So you see, you could actually write down the evidences by specifically highlighting the risks, that these are the risks that we are facing, so we can have the evidences from that. You could access further evidences while actually going through the exam answer, but that's how it is. So for those of you who are having a problem with the effective interest rate, so I'm just going to explain that what is the concept of effective interest rate. The concept of effective interest rate is simply the effective interest rate calculates the total cost that we bear on this loan. So all that you need to do is that you just need to actually calculate the total amount that you have paid against, that you need to pay against this loan over the period of the loan. So the total amount divided by number of years gives you the amount per year, and once you have the amount per year, what you need to do is that you need to actually divide it by the principal amount, so you will end up getting the answer. So that's how it is. Let's move forward, and now there are part B and part C. So you need to actually go through part B and part C. This is a 7-mark requirement for part B and 6 marks requirement for part C. Let's just go through it, then we'll discuss. No, Ifra, you don't have to write risk. That's what I explained yesterday also. You don't have to write the risk. All that you have to do is that you just have to write the evidence. So I'm just going to draft one or two answers also, because I think that you should know that how to draft the answer also. So I'm going to draft one or two part of it also. Yes, Nadeem, you need to explain that why exactly, what you would expect to find, what evidences and why. Okay, try to attempt these parts and then we'll discuss in 2-3 minutes. Okay, let's move forward and discuss further. It says in September 2014, I'm going to repeat again. You see, the dates are very important. You need to understand that what are the relevant dates in the given scenario. So it says that the year end is 31st July 2014, and if something is happening in September 2014, that means that it's event after reporting period. So it's event after reporting period. A natural disaster caused severe damage to the property complex housing the group's head office and main manufacturing site. For health and safety reason, a decision was made to demolish the property complex. The demolition took place 3 weeks after the damage was caused. Property had a carrying value of 16 million at 31st July 2014. A contingent asset of 18 million has been recognized as current asset and as deferred income in the group. Statement of financial representing the amount claimed under the group's insurance policy in respect of disaster. Now there are 2-3 things which you need to understand. One of them is the IAS 10 events after reporting period, which is anything that happens from the year end till the end of reporting period. Year end till the end of reporting period. Anything that happens from the year end till the date of authorization for issue. Till the date of authorization for issue, that is all considered to be the event after reporting period. So whenever we talk about the event after reporting period are of 2 types. And what are those events after reporting period? They are either adjusting event and they are either non-adjusting event. So what exactly is the accounting treatment for adjusting and for the non-adjusting event? For the adjusting event, what we do is that we adjust them in financial statement. We adjust them in financial statement, and the non-adjusting events are disclosed if they are material. If they are material. Now, if you could recall from what IAS 10 says, that adjusting events are those events that provide evidence of conditions. That existed at year end. So basically, adjusting event are those events that provide evidence of the conditions that existed at year end, and non-adjusting event indicates the events that arose after year end. Now, if I talk about this scenario, in this scenario, what has happened is September 2014, which is after reporting period, a natural disaster caused severe damage to the property complex housing the group's head office. So there was actually a natural disaster in September 14 causing a damage. So that means this event is something that is indicative of something that happened after the year end. It did not happen at the year end. It happened after the year end. And resultingly, the property is also demolished, and there was a 16 million thing, and etc. etc. So apparently, the scenario is not for an adjusting event. It's a non-adjusting event. Why is it a non-adjusting event? The reason behind that is that it took place on 30th September, and it provides indications of the condition that arose after year end of 31st July. So what should you do? You should not actually make this adjustment. You should instead disclose it. So basically, the 16 million damage divided by the total assets of 450 million gives you what? Three and a half percent. So this is 3.5%. So having 3.5%, which is a material item. So what will happen is you would say 3.5%, and since 30th September is after year end, therefore the natural disaster is event after reporting period. And it's a non-adjusting event after reporting period. Why it's a non-adjusting event after reporting period? Because Why is it a non-adjusting event after reporting period? The reason behind that is because what happens is that it provides evidence of condition that arose after year end. So what should happen is it should be disclosed in the financial. It should be disclosed in financial. And what should be disclosed? We should disclose the detail of the event and estimated financial impact. Now, another area that you should talk about is basically the contingent asset that they have recorded. For the contingent asset, what you should do is that the contingent asset does not exist at the year end. The reason behind that is the disaster took place after year end, so there is no as such contingent asset. They should actually reverse it. What have they done up till now? They have recognized the contingent asset as current asset and a deferred income. So they have recorded contingent asset debited by 18 and they've recorded the deferred income as credited by 18. So what should they do now? They should actually say that the deferred income would be debited by 18 and contingent asset to be credited by 18. Now, we need to talk about the various evidences that we would expect to find. So if I talk about the various evidences that we would expect to find, let's just talk about them one by one. Number one evidence that we need to talk is that details of disaster fixed asset register showing property of 16 million. Because you see, you need to think about what would have been your risk, that the damage, what exactly, when did the disaster took place? Was it on 30th September? Was it before year end? Was it after 30th September? What exactly was it? And what was the carrying amount of this property? What is the surveyor report? Another thing is that physical inspection report. Why physical inspection report? Because they say that it was being damaged, it was being demolished after 3 weeks after the disaster. So if it was being demolished, then have we physically inspected it? If we have inspected it, then do we have the report? So all this is important. Furthermore, you need to have the insurance policy, you need to have the claim made to the insurance policy, etc., etc. These are all things which are necessary for you for this specific audit. Now see, Mark Company supplies some of the components used by Roberts Company in its manufacturing process. At the year end, an intercompany receivable of 20 million is recognized in Mark Company's financial statement. So Mark Company, it actually supplies some of the components used by Roberts. At the year end, an intercompany receivable of 20 million. So 20 million receivable on a total asset of 450 will give you an idea. 20 divided by 450. Roberts Company financial statements include a corresponding intercompany payable of 50 million and an inventory supplied from Marks valued at 50 million. So you would talk about it that you'll calculate the materiality, and now understand. The area to be considered over here is that we need to talk about that since Roberts and Marks are group entity, for intra-group receivable and payable should be eliminated. Furthermore, any unrealized profit on unsold inventory shall be removed from financial statements. And then we can talk about the evidences, which could actually be the consolidation schedule showing elimination. We could talk about recalculation of unrealized profit. We could talk about the recalculation of unrealized profit. Then also we can talk about there could be the other things which could be like ledgers of both the parties in each other's books, so that we can have an idea that there was a transaction of this amount. So these are the things, these are the various evidences that you would expect to find. I hope this is clear. Are there any questions? Do you need to actually know anything about it? Zumana Zubair, the revision kit for June 2017 is outdated. Ideally speaking, you should have a new revision kit which is for September 2017 exam session. Why is that so? Because there are various accounting standards which have been introduced, specifically the IFRS 15 and the IFRS 16, and the revision kit is revision kit reflects amended accounting standard. Hassan Khan, you don't have to show the calculation of effective interest rate. It's just that I have performed the calculation to explain to you people. You could have simply written the finance cost to be recognized should be using the effective interest rate. For the sufficiency and appropriate, we will talk tomorrow. Abbas, you mentioned about that yes, detail of disaster. It's just that the details of the disaster or the disaster report, that what exactly the damage report, that is something what I actually meant. Written representation that they don't have going concern issue. Well, having a 16 million asset on a total asset of 450, so I think that's a bit of a vague thing. Rarwin, no, the demolition cost should not be recognized because it arose after year end. The event took place after year end. It wasn't actually at the year end. There is no contingent asset because the event took place after year end, and at the year end you did not have any asset. There was nothing in nothing had happened with you at the year end. Abbas, give me some time. I'll write down that how to write it down in the exam. They have to recover, but the point is, IFRA, they cannot show it in the financials for the current year. It has to go in the next year. Yes, recalculation is statement. It's not recalculation. Recalculation is a procedure. Recalculation is statement, could be a procedure. I'll try to do that. I personally like BPP. Farwa, on the WhatsApp group, I think few people have the revision kit. They can share that with you. Okay, if somebody has the updated version, please share it. Okay, for those of you who wanted to know that how will we write down the answer to this question, I'm just gonna share, let's say, one area. I would say that 20 million is X% of total assets and is therefore material. Since Marx and Roberts are group companies, therefore the transaction between them shall be eliminated from the group financial statements. So 20 million shall be deducted from group receivable and payable, and any unrealized profit in the unsold inventory shall be removed. I would expect to find following evidences in my review of working papers. So you would actually write it this way, but extracts from consolidation schedule showing removal of intra-group balance, recalculation statement of you people can take a screenshot of this. You don't have to write it down. You can take a screenshot of this, whatever that I'm writing. It's just that few people were actually concerned that how will we write, so that's why I'm actually writing it, so that your ambiguities or your problems is being cleared. Recalculation statement of unrealized profit. Furthermore, ledgers of Mark and Roberts in each other books showing outstanding amount of $20 million. I hope this clarifies now. Okay, I'm gonna reduce the screen size so that you can take a screenshot. Okay, so let's move forward and discuss further. So we are actually done with this area. We are going to move forward, and the next area that we are going to move on to is going to be the audit report. The next area that we are going to move on to is going to be the audit report. So let's just start off by discussing that what exactly is the audit report. So we're going to talk about the audit report. I've shared with you the handouts, and they actually include the audit report. There are two handouts, which is audit report 1 and audit report 2. So you can actually open up both the handouts, the audit report 1 and the audit report 2, both the handouts that are available. You can open up both of them. Okay, for the audit report, I would like to do some discussion first, and then we will discuss about that what should be the audit opinion in XYZ scenarios and all other things. So let's just start discussing first about this audit report. As you all know that the format for the audit report has actually changed. So it's very important to know that what is the new format and how it all operates, because at times what happens is you come across exam scenarios where it says evaluate or critically appraise the audit report. So when it says critically appraise the audit report, your examiner is expecting you to even tell him that where has he gone wrong with respect to the structure, with respect to the overall presentation of the audit report also. So you need to know that contents of the audit report, like what exactly comes in first, what comes in second. These all things are important. So let's just talk about the independent auditor report, that what are the components of independent auditor report. Abbas, you can access the handout from the window. Okay. The major changes to the audit reports have been, initially what used to happen was that the entire audit report was a very simplified report which did not have much of the contents. The only content that was there in the audit report is that it had a specific set format, and that set format used to operate like this, that it included the introduction para, and that included the auditor's responsibility, management responsibility, and there was a very small para at the end of the report indicating that indicating the type of the opinion that the auditor expresses. So earlier it used to be like this, but now over a period of time, when the audit report has actually changed, the ISA has revised. So the revised ISA, when it talks about the audit report, the first thing that it starts off with is the audit opinion. So the first thing that it starts off with the ISA is the audit opinion. So I'm going to talk about the audit opinion, that how does it start off. If you could see this audit opinion para, the first paragraph you would see the overall introduction about the company ABC, that this is the audited, we have audited the financials of ABC company for the period ending so and so, and it covers the XYZ statement. So you could see now the opinion paragraph is the first para with an introduction, and the second para actually reflects the audit opinion, which says, in our opinion, the accompanying financials present fairly in all material respects or give true and fair view of the financial position of the company. Okay, so the next paragraph is the basis for opinion para. It was never there. It has been included now. I mean, the basis for opinion paragraph earlier in the audit report used to be only when there was, it was only when there was a modified opinion. If there was no modified opinion, the basis for opinion paragraph never existed. So the basis for opinion paragraph, the auditor generally states that we have conducted our audit in accordance with AISA, and also that we are independent auditor in accordance with the international ethical standards for the accountants, and then also that the audit evidence that we have obtained is sufficient and appropriate for us to form an opinion. So these are the main important things that the auditor talks about in the basis for opinion paragraphs. So you could have a quick reading of the basis for opinion paragraph also. Now let's move forward. In addition to this audit report is this key audit matter section. Now what exactly is this key audit matter? So there is a specific AISA that has been introduced for this key audit matter. There's a specific AISA which has been introduced for the key audit matter. So I'm going to discuss about that AISA. So it's actually AISA 701, which has been introduced for the key audit matter. Now what exactly is the objective of this AISA? I'm going to discuss about this AISA. So AISA 701 has been introduced. It discusses the key audit matters. Now what are key audit matters? So the key audit matters are generally whenever you are performing an audit, you come across a lot of matters which you discuss with management and those charged with governance. So when we discuss a lot of matters which we discuss with management and those charged with governance, so amongst those matters there are few matters which are very significant, which are very important, and the auditor thinks that he should disclose it to the users of the financial statement. So such matters are actually termed as key audit matters. So what are key audit matters? Key audit matters are the matters that the auditor discusses with management and those charged with governance. And these are the matters which in the auditor's opinion are of such significance. These are the matters which are of such significance in the auditor's opinion that that the auditor should report them to the shareholders. That's why he presents them under the CAM section of the report. So if I talk about it, that how is it presented in the CAM section, you look at this audit report and you read the key audit matter section of the report. So if you see, so it clearly says that in our professional judgment were of most significance in our audit of financial statements of the current period, etc., etc. And then you have to give the description of each of the key audit matter in accordance with AISA 701. So what you need to do, you need to give the description of each of the key audit matter in accordance with AISA 701. Now let's move forward and let's just discuss further. So I'm going to talk about that. What is the description that we give for any key audit matter? So the description that we give for any key audit matter is, what is the matter? Why is it a key audit matter? And what has auditor done in respect of this matter? So that's what you have to do, that what is the matter, why is it a key audit matter, and what has the auditor done in respect effect of this matter. So this is the important thing. So this is number 1, this is number 2, and this is number 3. So this is what you have to do. So you have to write down. So like the audit report, originally the audit report was not that descriptive, was not that elaborative, but over a period of time, ever since this ISO 701 came in, the audit report format changed. So the key audit matter actually gives more insight to the user about the company. The auditor actually highlights that, like for example, if I talk about a company, we could say that there is a company which has got problems with the revenue recognition policy. The auditor discussed with management, those charged with governance, and the auditor ultimately got satisfied with the management's policy, but then he did had issues. So he could actually discuss about that in the key audit matter section, that the entity had this revenue recognition policy, which could be subjective, which could be etc. And then we performed XYZ audit procedure, and the result of the XYZ audit procedure was that we can now conclude that the matter has been correctly addressed by the management. So in the key audit matter section of the report, only those matters are presented. I'm repeating, in the CAM section of the report. In the CAM section of the report, only those matters are reflected which the auditor is satisfied are correctly presented. I mean, the auditor might not have been initially ready to accept these matters the way they were presented, but subsequent stage the auditor might have actually recognized that no, they have been correctly presented, and we can now actually they've been correctly presented, but still we need to reflect it to the management. So that's what the CAM section is. So the report has got the CAM section, and once we are done with the CAM section, there is this other information section. Now what is this other information section that I'm going to explain? If you could open up the next PDF file, which is about audit report 2. So in that file, you will find this page number 3 in that file, the audit report 2 file. There's this page number 3. So you would find examples of amounts or other items that may be included in other information. So there is items of key financial results. Let's say if I talk about its key financial results, you could see when you look at the financial statements of any company, you would find that there would be some specific 5-year history of the company, bar charts, various pie charts, various diagrams showing the historical performances of the company, showing the projected results of the company, etc. So you might actually come across a lot of things in the annual report. So whenever the annual report is published, the annual report includes, in addition to the financial statement, a lot of things. So generally speaking, all those things are the other information. So basically what happens is there is a section which is other information, which is accompanying the financial statement. And the way this section is presented is you open up then again the file of audit report 2, and you find page number 6 of that report. Come on to page number 6, and you can actually read this whole. Okay, now number 1. It says other information. So you could read from here that the auditor's responsibility is to read the other information accompanying the financial statements. And in case if the auditor thinks that there is an inconsistency in the other information, then the auditor should actually reflect the should discuss with management and those charged with governance. If they agree, then good enough. If they don't agree, then the auditor has to actually reflect them here in this specific section of the report, that XYZ other information shows information which is inconsistent with the financial statements. So the auditor can do that. The auditor could simply do that he could actually talk about that this other information is not correctly presented. We will take a break. We'll have a namaz break for 20 minutes, and we're gonna then start off at 7:20 p.m. Okay, welcome back. So we were discussing before the break about this audit report. So up till now what we have talked about is the next area for the audit report is other information. And we said that the auditor's responsibility is to read the other information accompanying the financial statement. In case if the auditor thinks that the other information does not give the correct information or the correct picture, then what he should actually do is that he should discuss with management and those charged with governance. If they agree to amend it, then good enough. If they don't agree to amend it, then the auditor should actually the auditor should actually mention in this other information section that XYZ area is not being correctly presented in the other information is not correctly presented, and that so that the users are aware about it. Because you see, what happens is when you are reviewing the annual report of any company, usually what happens is while reviewing the annual report, we see the initial pages of the report, which includes the director's report, which includes the forecast, etc., etc. So we need to make sure that we don't actually confine ourselves to that. Now next is the responsibility of management and those charged with governance. The ISA now specifically explains that who is management and who is those charged with governance. So it's actually the responsibility of management, it remains the same, is to prepare the financial statements in accordance with the IFRS and also to maintain internal controls. And the responsibility and to actually assessing the going concern status of the entity. Furthermore, those charged with governance are responsible for overseeing the company's financial reporting issues. So this was never there in the report, and this has now been presented in the report. That is that it was already there that the management is responsible for preparing the financial statements in accordance with applicable framework, and that the management is also responsible for maintaining internal controls, but it was never mentioned that the management is responsible for assessing the going concern status. Furthermore, those charged with governance was never mentioned that they have the responsibility for overseeing this whole. And then there is this auditor's responsibility, which indicates a few things, which is that that we are giving a reasonable assurance. And second thing is that the reasonable assurance is a high level of assurance, but is not a guarantee that an audit is conducted in accordance with ISA will always detect misstatement when it exists. So these are the important things. So this is this other auditor's responsibility section, and then we have got a section on report and other regulatory requirements, which is depending upon the local laws. And then you have got the name of the engagement partner, got the signature of the engagement partner, and then at the same time auditor address and the date. So these are the general content of the audit report, and they have changed. The sequence have changed. A lot of things have actually changed. Now let's move forward, and this is actually the basics of the audit report that we have gone through. We are now going to discuss further, and we are now going to discuss that okay, now let's discuss that what other types of this is generally ISA 700 that we have discussed. We have talked about ISA 701 also. Now let's just talk about ISA 705, which talks about the modifications to the report. ISA 705, which talks about the modifications to the report. Now if I talk about modification to report, so you do know that the modifications are of actually three types. One of them is a qualified opinion. And what do we say in the qualified opinion? We say except for so and so financial statements give a true and fair view. This is what happens in the qualified report. Now number two is basically your adverse opinion. And how do we write the adverse opinion? So the adverse opinion is written this way. We say that whenever we talk about the adverse opinion, we say that financial statements do not give a true and fair view. Financial statements do not give a true and fair view. And lastly, there is this disclaimer of opinion. And whenever we give this disclaimer of opinion, we actually say that we do not express an opinion. We say we do not express an opinion on the financial statements. So that's what it is. Now let's move forward. So this is actually three types of opinion modifications that we have to the financial statement. Now we are going to discuss that what are the reasons for giving such modifications. Now what could be the reasons for giving such modifications could be, it could either be that financial statements are materially misstated. So one of the reasons could be that the financial statements are materially misstated, and the other reason could be that unable to obtain sufficient and appropriate audit opinion. Unable to obtain sufficient and appropriate audit opinion, that's number two. So financial statements are materially misstated or unable to obtain sufficient and appropriate audit evidence. Now let's just talk about it. If I say that the financial statements are materially misstated, if I say that financial statements are materially misstated or you are unable to obtain sufficient and appropriate audit evidence, these are the two things on the basis of which we actually modify the opinion. Now let's move further and let's just discuss further. There is a terminology which is called pervasiveness. There is a terminology which is called pervasiveness. When you will actually open up this audit report handout also, you will find the definition of pervasive. You'll find the definition of pervasive on page number 5. So you will find the definition of it. So what exactly is the term pervasive actually means? So it says in the context of misstatements to describe the effects of the financial statements of misstatement or the possible effect, if any, that are undetected due to inability to obtain sufficient appropriate evidence. The pervasive effects on financial are those that in the auditor's judgment. Now, I'm going to explain this, that what is pervasiveness. So when we talk about the pervasiveness, so the pervasiveness actually refers to that you see whenever you are actually modifying the opinion, so the opinion is definitely going to be modified on some specific matter. Now what could be that matter? That matter could be that the entity has not stated the inventory correctly. The matter could actually be that you are unable to access the inventory of the company, therefore you cannot actually confirm that the entity's inventory is correctly valued or not, etc. So these could be the various things. So what is pervasiveness? Pervasiveness, whenever we talk about the pervasiveness actually means that the matter which is under consideration or the matter which actually on the basis of which we are modifying the opinion is very important, is very significant. Now, what is pervasiveness defined by AISA? So AISA says that pervasiveness is whenever multiple elements are misstated. Whenever the multiple elements are misstated, that is what pervasiveness is. That's number one. Like for example, you are auditing the financials, you figure out that inventory is misstated, you figure out that receivable is misstated. So when you figure out that these multiple items are misstated, so what actually happens if this is an indication of pervasive effect. Now next thing. So multiple elements are misstated. So whenever you've got multiple elements which are misstated, that is pervasiveness. Now number two is that when we talk about it, so we've got multiple elements which are misstated. Number two thing is a single element is misstated, but it's a substantial portion. Now, a lot of you would be that what do we mean by this substantial portion? So practically it is around 25 to 30% is substantial portion. Now, what is that substantial portion? Example is that you have got machinery or you've got a plant which constitutes 45% of the total net assets of the balance sheet. And the management is not letting you access that plant. Management is not letting you access that plant. If the management is not letting you access that plant, that means the matter is pervasive. And the third thing is, whenever we talk about the pervasiveness, so the third matter under when it comes to the pervasiveness is actually that it pertains to a significant disclosure. Now, what is that significant disclosure? If we talk about a general financial statement of the entity, so the significant disclosure when it comes to general financial is pertaining to going concern. So maybe the going concern assumption is incorrect. So maybe the going concern disclosure is inappropriate. That all indicates pervasiveness. So now, let's move forward. And let's just discuss further. So we have talked about that what is pervasiveness. So first thing is you need to understand if the matter is pervasive or not. Now, if the matter is pervasive or not, so you need to understand that how exactly are we going to deal with it. We are going to deal with it this way. We're going to deal it with this way. Now, what is going to be this way of dealing with it is that okay, so let's just talk about this pervasiveness. Now, first of all, we said that there could be the two things with respect to these things. One of them is financial statements are materially misstated. The other one of them is you are unable to obtain sufficient and appropriate audit evidence. Now, if we look at it, financial statements are materially misstated. What do we mean by that? Financial statements are materially misstated. We mean by that is, number one of them is basically you would see whether the matter is pervasive or non-pervasive. So let's say this is the column which is called not pervasive. So if this is not pervasive, then means whether it's material misstatement or whether it's inability to obtain evidence, in both the cases it's going to be qualified opinion. The second one of them is if the matter is pervasive. If the matter is pervasive, then you need to see that what is the reason for modification. Is that because the financial statements are materially misstated? Then you need to give an adverse opinion, which is the financial do not give a true and fair view. But if it's a matter which is inability to obtain sufficient and appropriate audit evidence, then it has to be a disclaimer of opinion. So you need to understand these two things, which is the matter pervasive or non-pervasive? If the matter is not pervasive, then it's going to be qualified opinion no matter what happens. But if the matter is pervasive, then you need to see what's the reason. Is it material misstatement? Then it's adverse. If it's not material misstatement, if it's inability to obtain evidence, then it's disclaimer of opinion. So you should be able to detect this in the given scenario. That's important. Now what next? In the audit report 1, we have actually mentioned about this qualified opinions. So you would see that the heading of the report changes from opinion to qualified opinion. The heading of the opinion para changes from opinion to qualified opinion, number 1. So you could see that it's the same introduction para, it's just that in our opinion, except for the effects of the matter described in basis for qualification para, the accompanying financials give a true and fair view. Now next, instead of basis for opinion, it will become basis for qualified opinion. So when we talk about it, it's basis for qualified opinion. It says that company's inventories are carried in the SOFP at so and so. So you see now here the entity faced this issue that the company's inventory were misstated, they were not stated at the lower of cost or NRV. So they actually discussed about it that if there is an effect, if the company's inventory would have been carried at the lower of cost or NRV, then what would have been the effect on the financial statement? So you see, when it comes to the basis for qualified opinion paragraph, you need to talk about few things. Number one of them is what exactly is the matter. I mean, see the inventories, so you need to talk about their carrying amount. Then you need to talk what is the problem. Like the management has not stated the inventory at the lower of cost or NRV. Then the third thing is that the effect of the rectification on the specific amount and on the cost of sale or the net income and the shareholders' equity, the effect. And the same goes for the key audit matter section also, that in the key audit matter section you say, in addition to the matter described in basis for qualified opinion section, we have determined the matters described below to be the key audit matters to be communicated in our report. Now there are two things which I would like to clarify over here which are important. And what are those two things? Number one, at times the student find it difficult for the key audit matter section that how to actually what is a key audit matter. So see, the key audit matter, I will repeat again, it is in the auditor's judgment, one of those matters when in the auditor's judgment should be brought to the attention of the shareholders, to the user of financial statement. And the important thing is, it should be amongst the matters which are discussed with management and those charged with governance. So it has to be amongst the matters which are discussed with management and those charged with governance, number one. Number two, whenever we have got a modification to opinion, whether that be qualified, whether that be adverse opinion. So whenever we have got modification to opinion, so such a matter is also a key audit matter. Now repeat, why is such a matter a key audit matter? Because had it not been a key audit matter, it would not have been so important that it could lead to modification. So whenever we have got a modification, the modification is also on a key audit matter. But what do we need to do? So amongst the various key audit matter, if a key audit matter is being resolved, I mean the management actually explains to you that they have done XYZ accounting treatment and for what reason, etc., etc. And if you are satisfied with that, it will be shown in the key audit matter section of the report. But if you're not satisfied, if there is a dispute between you and the management and that dispute stays unresolved, then what will happen is you will actually use such a key audit matter to be explained in the basis for the modified opinion paragraph, and you would modify the opinion on the basis of such key audit matter. So if you read this key audit matter section of this qualified report, it says, in addition to the matter described in the basis for qualified opinion section, we have determined the matters below to be the key audit matter. So in addition to that. So that's what you need to understand. And then you need to understand one more thing, which is the concept of disclaimer of opinion. You see, when we give a disclaimer of opinion, we say we do not express an opinion on the accompanying consolidated financials of the group. And then you give a basis for disclaimer of opinion para. So remember one thing, whenever there is a disclaimer of opinion, there will be no key audit matter section in the report. There will be no key audit matter section in the report. You would say why? The reason behind that is, in the key audit matter section of the report, you say that amongst the we do not express a separate opinion. I mean, you actually say that whatever the opinion is there in the on the financial statement as a whole, that's the same opinion for these matters under the CAM section. But now, since you are not giving an opinion, then this does not make sense that you can actually discuss about CAM, because CAM actually refers to the matter which have been resolved between you and the management, and you're okay with those matters. So how could it be possible that you are giving a disclaimer at one side and you are actually giving this CAM section in the same report? You can't do that. So that is an important area, which is about disclaimer opinion. So I think that is all about ISA 705 also. I think it's been some time that I haven't answered your question. So I will actually answer your questions first and then I will move forward. Daud, your query is you will get the recorded lectures. ACC has a policy, they would actually send across the lecture. Daud, you already have the link. If you are unable to join through that link, please drop in your your number here. Somebody can actually send a message to you. Farwa, for the other matter section, just wait for a minute. Yes, the other information section, to an extent, the matters which used to be discussed in other matter paragraph have largely been replaced with this other information section. So yes, there is a lot of things. I'm going to explain what is other matter and what is other information. Just wait for a second. CAM has been applicable, Rabia, for some time now. Just wait for a while. I'm gonna actually recall all the things. So now see. We were on to it that these are the few things which we have discussed with respect to the audit report and with respect to the basis for disclaimer of opinion, etc., etc. Now let's just talk about the emphasis of matter and other matter. Okay, what is this emphasis of matter and other matter? A lot of you would be concerned that I talked about the key audit matter section. Now where does the EOM comes in, where does the other matter goes, etc. So now let's just try to understand that what is EOM and what is other matter, etc., and how are they different from CAM. So whenever we talk about the emphasis of matter and the other matter, so it's ISA 706, which talks about the emphasis of matter and other matter section. So emphasis of matters in accordance with ISA 706 is refers emphasis of matter is a para included by auditor in order to draw attention of users to a matter correctly reflected in financial statement. So what is emphasis of matter? Emphasis of matter is a para included by the auditor in order to draw the attention of the users to a matter correctly reflected in financials. Now, many of you would have concerns that, okay, that if EOM is there to reflect a matter which is correctly presented in financial statement, and CAM is also there to reflect those matters which the auditor thinks have been correctly reflected by the financial statement, then what is the difference between EOM and CAM? So now see, the main difference between EOM and CAM are the EOM and CAM, the major differences between them are that CAM is amongst the matter discussed with management and those charged with governance. If there is a matter which you have not discussed with management and those charged with governance, it cannot be under the CAM section. But there is no such thing for EOM. EOM doesn't need to be discussed with management and those charged with governance. Number two, for the CAM, it usually refers to an area of risk in the audit. Like an area where you and management have argued, the area where you and management have actually had some discussion. But EOM generally refers to where as such there is no dispute, where there is as such no argument. So both the matters are correctly reflected in financials, but on one matter we had an argument with management and on the other matter we had no argument with the management. Then next, we give detail of work done. Over here there is no detail of work. It's just that in the emphasis of matter section we just say we draw attention to note X in the financial statement. Say we draw attention to the note note X of the financial statement, which describes the effect of the fire in the company's production facilities. Our opinion is not modified in respect of this matter. Like, it's a matter which management wanted to highlight, but then again the management says that it's being correctly reflected. So the auditor says it's being correctly reflected by the management, so we don't need to really actually say much about it. Now let's move forward. So this is actually, we are done with this emphasis of matter. Now let's just talk about the other matter section. So when we talk about the other matter section, so I'm going to explain that what is other matter. The other matter refers to a matter other than financials. I mean, a matter which is not pertaining to financial statement is another matter. So I'm repeating it again. A matter which is not pertaining to financial statement is another matter. Like for example, if I say that what exactly is going to be other matter. So earlier, the information which is presented in other information section used to be presented in other matter section. Like for example, there is a report by the management, and that report is not part of financial statement, it's just part of annual report. So there is some report by the management, the contents of which are not in line with the contents of the financial. So what is the management going to do? So if the contents are not in line with the contents of the financials, so what exactly is the management going to do? So it is actually going to be that the management used to give other matter para. But now the other matter para only covers matters which are not reflected in other information. Like for example, there are few things that last year financial statements were audited by another auditor, or maybe you could say that last year financials were not audited, etc., etc. So this is what the other matter section reflects. I hope this is clear now. So what we are going to do now is we are going to move forward, and we shall discuss one of the questions on the audit report. Okay, let's go on to December 2014. Question number 5. Part B. You need to go through this area. Kindly go through this question, read this question, we'll discuss in 5 minutes time. So it's December 14, question number 5, part B.
कुछ आपके लिए रिफ्रेशमेंट मंगा लेंगे ना पहले से, आप बता दीजिएगा क्या मंगाना है। प्रेजेंटर और ऑर्गेनाइजर। बच्चों को पता नहीं क्यों मसला हो रहा है, मुझे समझ नहीं आ रहा।
Okay, welcome back everybody. There was some technical issue and we could not unfortunately go on in a proper manner because of that technical issue. I do understand a lot of you people are having concern that the class got boring and the class got disturbing. I do realize this thing. In order to make up for that, I will extend the class by I would extend the class by 30-35 minutes for both the coming days, just to make sure that we have been able to make up for the lost time because of the technical faults during the course of the day, and also because of these issues that have actually arisen. What I actually want to discuss is, actually I would have discussed the question, but unfortunately I think since it's not announced in advance that the class is gonna continue for a longer period, so a lot of you might not have actually been prepared for it. So what I'm just gonna write down is I can actually give you few questions which you can attempt, and then we can come back and we can discuss tomorrow on these questions so that we could actually have a bit of a fast move. Now, one of the questions that you can actually talk about is it's December 2014, question number 5, which I already mentioned, question number 5 part B. That's one of the questions that you should do from home. The other question that you should do is this June 2016, and this is question number 5 again. So it's June 2016, question 5. The third one of them is December 2015, and this is question number 5 again. So I would just write down the name of these questions. So this is actually Hopper Group. This is Hopper Group. This question is Boston Company, and this is Bradley. So this is what it is. Now, these are the questions which I would want you people to actually go through at home, so we can have a discussion tomorrow on these questions. Now, for the questions that you have actually asked me, so I'm gonna start replying to every single question that you people were asking. 8:33. Okay, we had this technical issue at around 8:12 p.m. So let me answer all the questions. What happened? Add me to the group. Wally, I don't know. Ifra, the adverse opinion actually means that you say that the financial statement do not give a true and fair view. Why would we go for an adverse opinion? The adverse opinion is given because when the financial statements are materially misstated and the matter is pervasive in nature, so that's why we give an adverse opinion. Poonam, see, the revision kit also has the past paper. So it's actually, I would recommend that you specifically, I would just give a list of the questions that you need to attempt. So I would suggest that you attempt those 15 questions that I say, so you could actually do that. Wally, I actually wrote down a specific question about that, how to discuss the management and those charges, how to discuss the comment on the matters. So I talked about it, that we talk about materiality. Okay, you are asking about key audit matters. So I talked about this key audit matter, that whenever there is a key audit matter, we specify, we explain what is the matter, then we explain that why is it a key audit matter, and the third thing is what have we done with respect to this matter. Okay, Rabia, disclaimer of opinion is basically when you say we are not giving any opinion. When you say we are not giving any opinion, that's called disclaimer of opinion. Now, why would you not give an opinion? You would not give an opinion because you had insufficient evidence and the matter was pervasive, that you preferred not to give an opinion. For the group audit, Dawood, we did a question called Teapot Company, December 14, question 2. Hamid, continue with me during this session. I'm sorry that the session today was was not had issues in the last 1 hour or so. So we will extend the session tomorrow and day after tomorrow also, so that we could cover up for the lost time. We would extend one break for 10 minutes and then we would cover up say around 30 minutes every day. Wali, to what extent we need to discuss such? I mean, it's to what extent it's just that you need to discuss about their relevant accounting treatment. That's it. Okay. Anyways, that's it for today. Right now, you need to attempt these questions, and the class will be extended on Thursday and on Friday. That is, it will be 6 to 9:40 p.m. or 9:45 p.m. 6 to 9:45 p.m. So that's how the class will go on with 2 breaks, one for the Maghrib Namaz and one just around this Isha time. So that's how we'll go about for the next 2 days. Rana Imran, I have not actually discussed the last question about this this audit report, so please give me time for tomorrow that I'll discuss the question with you people in a bit of detail for tomorrow. No problem, Sania. I mean, if the session is being conducted, it's just being conducted to ensure that you people enhance your chances of passing, and that's why I'm actually staying very much exam focused, and we can cover up for the lost time, whatever that is. Wajih Khalid, emphasis of matter is actually given when the auditor wishes to highlight a matter which has been correctly presented in the financial statement. Anyways, let's keep it till here. We will continue tomorrow at the same time, 6 o'clock, and we'll continue it till 9:45 p.m. So, hoping to... Ifra, my suggestion to you would be that if you open up the BPP kit, you will get an analysis of the questions. Queen Mary, as earlier we told you, that the recordings would be available after the session is over. Anyways, let's... Wali, I mean, I don't understand that. What do you need to know? Amended question you should do. Wali, you need to wait till tomorrow because I have not gone through the questions up till now for the reporting. Ifra, the WhatsApp group has already been shared on this chat earlier. Also, you follow the link to that. And please, I would request everybody to actually talk about the subject only, because then a lot of other talks start, and that's not good for the group because then it loses its significance. Anyways, let's keep it till here. Let's meet up tomorrow and then we'll discuss further. Okay, I will send across Wali in email form. I'll ask them to send across in the email form. Okay, thank you very much. See you all tomorrow, inshallah.